talk about financial stability in the euro area, and we need to talk about the macro outlook, because clearly there are so many clouds on that. So what is the implication from that on financial stability?
Well, many clouds give rise to uncertainty, and I think that uncertainty now is the name of the game, in financial markets, in the global economy. I think that uncertainty is related to policies of the new U.S. administration with respect to trade, with respect to fiscal policy, with respect to regulation of banks, non-banks, cryptos, and I think that this is the main element that we are considering now, and the potential impact that this might have, for financial stability in Europe.
We need to talk about debt in the United States. They just got stripped of their their only AAA rating by Moody's, and that had implication on the bond market. So are you concerned about that this could trigger more financial instability?
Well, I think that the downgrade, was more or less expected, because the other two large rating companies have downgraded the U.S. Treasuries and the U.S. government bonds. But I think that the focus of the attention is going to be fiscal policy and how fiscal policy evolves. And now the level of debt in the U.S. is very high. There is a large structural deficit, and let's see the decisions taken by the new U.S. administration. But I think that fiscal policy is going to be an important element. And as well, it's something that we have, included of one of the potential vulnerabilities in the euro area.
I remember the days of the debt crisis when everybody was concerned about yield levels around 6%, especially for Spain and Italy. So now we are close to that in the States. So is there a risk of a debt crisis?
Well, I think that the situation in the euro area has improved quite a lot. If you look at, for instance, the situation of Italy, Portugal, Greece, Spain is totally different now. They have addressed problems in the banking industry. Now the fiscal situation, the fiscal profile is much better than it used to be, and the competitiveness of the economy. If you look at the balance of payments of these countries, they have improved quite a lot. So I think that the situation is very different from the one that we had 15 years ago.
Yes, clearly. And my question was actually referring to the States, whether there's a risk that people will really vote with their feet and go away from U.S. Treasuries.
Well, the U.S. continues to be the U.S., and I think that the dollar is the reserve currency of the world. I think that we should not get confused. It's clear that some of the policies of the U.S. administration have created some uncertainty, but the U.S. economy continues to be the main economy of the world, and I think that the status of the dollar as a reserve currency is not going to be challenged in the short term. Here immediately the question is, what's going to be the role of the euro? And I think that is going to depend on the policies that we pursue in Europe. If we apply the correct policies in terms of capital market union, banking union, integration of services and good markets, I think that the role of the euro will be enhanced, and the euro will gain market share at the global level. But so it depends. It's in our hands, in the hands of the Europeans.
You've been referring to the tariffs and that looming threat, because we just are in the middle of a 90 days moratorium somehow on it, and some are already enacted. So what are, in your view or in the institution's view, the effects of tariffs on price developments in the euro area?
I think that this is a very relevant question. I think that in the short term, in the very short term, a tariff is a tax on imported goods, so it's going to have an impact on inflation, negative impact on inflation. It will raise the prices of the imported goods, but simultaneously you have to consider that it's going to depress domestic demand and global demand. So I think our approach is clear. In the medium term, perhaps this decline in domestic demand will more than offset the initial increase in prices because of tariffs. And finally, in order to make it a little bit more complicated, you have to look long term. And long term, if tariffs and trade distortions give rise to fragmentation, that will be detrimental to the supply chain, and that could increase the costs of the corporates, and that could be inflationary. So to summarize, I would say that it's clear that tariffs are going to be detrimental to growth, but the effect on inflation is much less clear. It will depend on the time horizon that you are considering.
Yeah, the markets seem to think that it has rather disinflationary effects because the market has shifted towards more rate cuts than before. Do you think the market is wrong or right?
Well, markets sometimes overreact, and they adjust, to the evolution of the economy. So it's an indication, but it's not a perfectly guiding principle. Let's call it that way. No, I think that, for instance, here there is another element that is the evolution of exchange rate. If you have, for instance, an appreciation of the euro, that's a positive, development for inflation in the euro area. And, besides the exchange rate, you have, for instance, the evolution of raw materials, energy prices. That is also positive. So, all in all, I think that the tendency and the trend towards disinflation is going to continue. And this is something that is very relevant for us.
What is quite stunning is the fact that equity markets, after falling quite a bit on the tariff news, are now back at pre-tariff heights. So how big is the risk of a severe market correction?
Well, there is a risk. I think that now, we have, two different elements to consider. On the one hand, valuations, as we have said in our financial stability review, are very rich, are elevated, are high, and simultaneously you have a high level of uncertainty. And markets are very benign with respect to this scenario. They believe that growth is going to be low, but we are not going to enter into a recession. Inflation is going to decline, and monetary policy will follow suit. Let's call it that way. So, but perhaps there are potential risks, and we do not know what's going to be the final outcome of trade policies, of fiscal policies, of the regulation from the new U.S. administration, and these elements give rise to volatility. I think that volatility is perhaps the consequence of these two elements that are at odds: valuations and uncertainty.
One other aspect is fiscal spending. That's why markets as well have been rising, especially here in the euro area, and also the fact that money is coming from the States to Europe. So what do you make of that mix when it comes to fiscal sustainability and as well the ability to actually spend enough on defense infrastructure across Europe?
I think that defense spending, that is a need for Europe, is a priority for Europe, a political priority that I can understand perfectly, is one element that we have to take into consideration. And on the other side, you have that the potential impact coming from the U.S. and that the uncertainty that we have now is having an impact on growth. So the new two elements for fiscal policy in comparison with the situation that we had 6 months ago is first defense spending as a need, as a political priority in Europe, and secondly quicker growth. So these are additional elements to take into consideration. And I think that is very important to try to convince markets that even though we are going to spend more, on defense, and that there are, clear reasons behind, and simultaneously that growth is not going to be very high, that we send the message, a very clear message to markets in terms of fiscal consolidation. I think that that's quite important.